STBB. And today we are going to be dealing with investing in property. I think that is such a prevalent question at the moment. Should I be investing, not what, in which areas, things like that. And Armand, our conveyancer director from our Four West branch, is going to be sharing with us the input on investing in property. So just before I hand over to Armand, I'm also just going to go through a few house rules with everyone and a few questions that you might have. So first of all, remember this is a meeting, so if everyone can please remain muted for the entire session. The presentation slides will not be made available, but we do have a very nice handout that we will be sharing afterwards. That will be a summary of today's session. You can also have a look at our brochures on our website. And then next up, the questions. So today's session is going to be jam-packed. You can post all your questions in the chat. And we will leave time at the end of today's session to go through them. Those that we don't get to, we will try and answer them in email, otherwise get back to the relevant person regarding them. Then in terms of queries and administrative queries, you can email marketing. So that would be for any certificates, any recordings, things like that. You can please email marketing1@stbb. If you need more information on this specific event and information that Armand has shared today, we will also be sharing his email address with you in the chat box, so you can get hold of him. Then just in terms of certificates, there will be certificates available. It is subject to our attendance policy. So you need to be in attendance of this session and for the entire session for us to be able to issue a certificate. People who watch a recording will unfortunately not receive a certificate. Your certificates and the recording will be shared within 48 hours after today's session. So you can look out in your inbox for that after today's session. So then without further ado, I'm going to hand over to Armand, who is going to be leading us through today's session. Thank you so much, Armand.
Thank you, Leonie. Good morning to everyone. As Leonie said, this is a very prevalent topic at this point in time. Let's delve into it immediately. Many of us consider investing in additional property or properties at some point or another in our lives, especially when your finances are in a position to allow you to consider this form of investment. Once a decision is made, however, many bridges need to be crossed. As a conveyancer, experience has shown that investor purchasers find it challenging to navigate all the options. Is it better to buy into a new development or rather a do-up, an existing home? Is sectional title the go-to choice or rather freestanding homes? Do banks have the appetite to support investment by offering home loans at present? So in our discussion this morning, we will mainly focus on the types of property available for investment purposes. But before we start looking at that, you first need to decide in which name you will be buying this property. Not knowing whether you want to buy the property in your personal name or in the name of an entity such as a trust or a company before you go house hunting is never a good idea for multiple reasons. Each option has a list of pros and cons, and unfortunately we don't have the time to dissect this particular aspect this morning. But there's one thing that I want to highlight in this regard, and that is the importance of taking advice from a tax expert before you decide which vehicle to use when you want to buy property, especially from a capital gains tax point of view. Although trusts provide good protection when it comes to property ownership, this type of property ownership is heavily taxed when property is sold. So, if the intention is to keep the property for children and grandchildren, then ownership in the form of a trust is a good idea. But if you are planning on buying and selling property, not so much. It is therefore vital that you have your ducks in a row before you intend on signing a sale agreement. So before we jump into the nuts and bolts of the various property types out there, let's first have a look at some interesting stats on the size and the makeup of South Africa's property market. If we can just get to that slide. Where? Okay. So in this first slide that we've prepared for you this morning, you will see that according to a recent Investec Bank article, it was noted that South Africa's residential property market is valued at a staggering 6.6 billion rand. Quite big if you look at those numbers. This figure is made up of approximately 7 million registered homes, which number could increase drastically in the near future if one looks at the value of plans for new units approved in 2023. In a recent Better Bond article, the value of those new plans approved is sitting at a staggering 50 million rand. So if you break this 6.6 number even further down, you will see that it consists of roughly 7 million registered homes, of which about 80% represents freehold property and about 12% sectional titles. And 7% you will find is homes in gated communities like homeowners associations. You will then further see there that the properties valued at 1.5 million and more make up about 18% of that 7 million registered homes, but the value contributes about 54% of the total market value. And then if you look at the next one, you will see that there is about 45% of homes are valued at below 700,000. And sorry if I can just... So it's 42% of homes valued at below 500,000 or less, contributing to plus minus 11% of that 6.6 billion rand. And then 55% of homes are valued at below 700,000, and that is of that 6.6 billion figure. So we'll see that the property market is quite enormous in our economy, and it's therefore always a good idea to invest in immovable property, provided that you do your homework before you put pen to paper. And then lastly, a very interesting stat is that on a provincial point of view, 38% of all properties of that 6.6 million, and then also the 7 million registered homes, fall within the borders of Gauteng, followed by the Western Cape at 29%. So, and that is largely because Gauteng is still seen as South Africa's economic hub, and obviously the most need or the biggest need for residential places to stay will then fall in the borders of Gauteng. Okay, having had a look at those stats, let's start off by looking at the first item on our show this morning, and that is buying into a new development, or what we call off-plan. So buying a property off-plan means that one is buying a property before it has been built, or sometimes during the building process. The decision to purchase is therefore largely based on the developer's vision of the end result, as reflected in an artist's impression of the development that is presented to would-be buyers, architectural plans made available, and other marketing material. The sale agreement is usually structured to require the purchaser to pay a relatively small deposit up front. Transfer documents will then be signed later on in the process, and the balance of the purchase price will be paid months later when the registration of the development or the scheme goes through in the deeds office. Before we look into this particular item a little bit further, I've put up a graph here for you this morning that shows the property registration sales in about 5 provinces in South Africa over the last 5-6 years. And again, you will see that Gauteng outperforms the other provinces by far, mainly because Gauteng is still seen as the economic hub of South Africa, as I mentioned. But you will see from those numbers on the graph that there's quite a few transactions that have been concluded in all provinces over the years. And it just goes to show that the property market is still healthy and active in South Africa. Okay, so we move on to what we call the alarm bells when you want to buy off plan into a development. And I haven't put these items up for you to deter anyone from buying into a development. It is mainly put up there to illustrate that buying off plan is something that requires proper homework before you get into that sort of investment in the property market in South Africa. So, you know, the building projects do not always go according to plan and results in the purchaser not receiving the home he had envisioned based on the marketing material. There are various reasons why this occurs. Sometimes the blame is with the developer for employing building contractors who are not adequately skilled to work on large projects and whose building work is substandard, or because the purchaser, as a layman, in the extent of building plans, formed a different and very rosy picture of the end product in his mind, and a different end result that the developer tried to reflect in the architect's representations. In addition, site levels and other challenges may necessitate deviations that were not anticipated initially, for which the agreement with the purchaser usually makes provision by allowing the developer to make minor deviations as may be necessary. Sometimes the consent of the purchaser is required, but often the developer is granted a green card in this regard for practical purposes so as to able to complete the project. This is fair because the development project's progress cannot be interrupted every time a minor change to plans is necessary. Nonetheless, it may really inconvenience a purchaser where, for example, due to the site levels, the builder had to install 1 or 2 steps between rooms. As a conveyancer, one also encounters dissatisfaction on the side of purchasers when they are presented with invoices for additional costs, such as connection fees of services, building plan approval costs, and interim interest on building loan agreements during the construction period. Although these are legitimate charges, if unexpected, it puts the purchaser in a difficult position to find additional funds and causes frustration. Another consideration to take into account is the time it will take for your proposed investment to materialize. Developers often propose a certain timeline for completion of the project, only to have that time pass without the purchaser being able to take occupation of their unit, and construction is still being far from completed. Again, there are various valid reasons for this outcome, and this is not necessarily a blame you can lay at the feet of the developer. Nowadays, we have a construction mafia to deal with. Building subcontractors that strike are involved in other projects that are delayed, and hence they cannot attend to the current project and the like. But the blame sometimes ascribed to the developer who uses unprofessional contractors, is guilty of poor planning, or is looking for shortcuts. In certain instances, in respect of poor workmanship, a purchaser's recourse would be to approach the NHBRC for relief and appropriate action to be sanctioned against the builder. But experience has shown that this can be lengthy and a painstaking process not worth the effort. The message I want to convey in mentioning these downsides of plan is that it is crucial to obtain accurate details of all the related costs to the purchase of the property. This will assist your budgeting and determination whether the purchase is within the limits of your funds you wanted to spend, and avoid dealing with expenses not planned for. You need to understand the timing of the project's finalization cannot be guaranteed. And these potential problems are exacerbated where the sale agreement has provisions that allows the developer or the builder to change the plans moderately as they go along. It is therefore essential that buyers make a concerted effort to understand the negotiation and sales process and possible risks before investing. It is prudent also to look into the developer's reputation, visit previous developments, speak to estate agents and conveyancers, and make sure that the developer in the project you are keen to invest has a solid reputation. Once you have established that the developer is reputable, even if there are some defects within the building, you can rely on them to fix the problems. A dependable developer will ask the purchaser to inspect the building's finishes and fixtures within the specified days of occupation, and then to provide the developer with a list of defects so that they may be fixed. So the NHBRC, it's an institution that basically protects consumers out there, and it was established way back in 1998. Its mandate is to protect the interests of purchasers by ensuring that builders comply with the prescribed building industry standards. It thus protects purchasers from unscrupulous builders who deliver substandard houses, bad workmanship, and the use of poor quality material. The NHBRC holds all builders who register with them accountable and holds them to a wide range of requirements before they can commence building. One of these requirements is that a certificate of enrollment needs to be obtained before the foundations of the development are laid. To fulfill this requirement, each builder must provide the approved building plans of the development, as well as a specification schedule of the actual construction to be done and the building materials the contractor intends to use. The approved plans, together with the developer's building contract, must be supplied to purchasers before the construction commences. The NHBRC further inspects all enrollment homes at key stages of construction to ensure against poor workmanship and to allow them to issue a non-compliance to the builder should that be the case. The NHBRC also provides purchasers with warranty cover for any minor defects which are identified within the first 3 months of construction, roof leaks identified within the first year of occupation, and cover against major structural defects within the first 5 years of occupation. Should the builder be unable or unwilling to rectify the defects, the NHBRC can rectify them following the completion of a complaint procedure by the purchaser. So a lot's been said about the things that you need to be on the lookout for, but on the positive side of things, one can look at financial benefits in buying into a new development, and there are actually quite a few. And the list of benefits that there are might completely outweigh the negatives in buying into a development. Buying off-plan does require a level of trust, but can often work out to be a cheaper and easier way to manage the finances in a transaction, because deposits are generally lower than if you're buying an existing home. An existing home could be freestanding or sectional title. The payment of the balance of the purchase price, if you are paying cash, will only be due on completion, and it is also possible to finance the purchase through a loan with a bank against registration of a bond when the scheme registers. In the latter event, the bond repayment obligation only arises after registration. Thus, there is a period in which the purchaser can build up some reserves whilst he or she waits for the scheme to be registered at the deeds office. Another advantage for the purchaser investor is that this transaction will not attract the obligation to pay transfer duty, which otherwise makes up a considerable portion of the costs associated with acquiring property in general. In new developments, the developer as a VAT vendor selling properties in his business enterprise will not be or will be the party that is liable to SARS for the payment of VAT. So in property transactions, when it comes to the tax levied on acquiring a property, either transfer duty or VAT is payable. But in most instances, when it comes to new developments, developers are registered for VAT, and therefore VAT will be payable, which removes that tax burden from the buyer itself. And the VAT portion will normally be built into the purchase price of that particular property. But as I said, there's normally a huge tax saving for buyers buying into new developments. So a side effect of the waiting period between the time of signing the sale agreement and transfer taking place is that there's a strong likelihood that the property you bought has in the meantime already appreciated in value and that's a very attractive feature for you as an investor. From a resale point of view, estate agents and conveyancers will confirm that the investment in a new development often yields a good profit on resale. This is because newly built homes tend to fetch higher resale values than older properties due to their incorporation of modern building materials and technologies. Let's look at this slide. Yeah, so there you will see a summary of the things that I just mentioned now. Some other benefits that are applicable and that you can find in new developments will be aspects such as the home is a blank slate that you can furnish and fit to your personal taste and requirements, or suitable for a high-end tenant. There is likely to be much less maintenance and upkeep than is otherwise required in respect of second-hand homes. The new home is likely to be constructed using durable, modern materials that require less upkeep than those used in older homes. Often developers also make a concerted effort to incorporate energy efficiency in the development and incorporating green technology. We all know what sort of issues the Eskom and load shedding has brought to the table. And many of the developments going up now at this stage do come with solar installations and sometimes also even water backup systems that might be a good selling point, and it will provide you with that sort of comfort that you need in living in a property. Furthermore, many new developments that are not sectional title developments have homeowners associations that oversee maintenance and repairs, easing the burden on homeowners. Another distinctive additional requirement or additions to these sort of developments is additional security, CCTV cameras, security guards at gates, swimming pools, state-of-the-art fitness centers, and sprawling parks and the like. So, in short, although buying off plan is not for the faint-hearted, once you have ascertained that you are working with a reliable developer and its teams of builders, it can bring excellent results in an investment for you. Second item that we're going to have a look at this morning is called buying a fixer-upper. A fixer-upper is what we call a second-hand home that you buy and you spend some money on renovations and you then sell it on at a profit. This is definitely something that many people have considered in the past, and as I said, they've actually yielded quite a good profit from this sort of property investment. It's not, as I said, a new sort of form of investment out there. It's been around for some time, but now recently on television, shows as Fixer Upper, Flip or Flop, and Flipping 101 of it, and various variations thereof have also put the emphasis on looking at something like that to invest as an investment option. Although the concept sounds straightforward, one needs to know that what you are letting yourself in for. So what is the advantages of these fixer-uppers? Well, the price at which these properties are acquired. Properties that, that require repairs and maintenance at the time that they go onto the market usually do not fetch high-end prices, and they are therefore very attractive to investors. Sellers are also aware of this fact and know that their properties may be a difficult sell at an inflated price. Estate agents guide them as to a reasonable listing. Due diligence for you as a buyer when you look at these things is that you need to have people that surround you that have knowledge of the market and of building projects that you want to undertake, so that you can make an informed decision before you jump into this form of investing. So what are the things that you need to be on the lookout for and that you need to consider? Well, first one up is determine what you can afford for both the purchase price of the property and the planned renovations. Purchasers interested in this avenue often consult with a mortgage originator beforehand to discuss the value of a loan that the purchaser is likely to qualify for, taking into account the funds required for both the property and the planned renovations. To make a profit on a fixer-upper, the purchase price plus the total renovation costs need to be low enough that you can recoup your investment with a profit in the shortest possible time. Some people work on what we call the 70% rule. This relates to the after repair value, ARV in short, the estimated value of the property after it has been renovated. For example, if the ARV is 1 million and the property needs about 250,000 in repairs, then a purchaser's initial investment should not exceed 700,000, 70% of the ARV. The property must therefore be acquired for around 450,000 Rand, ideally, and spending on renovations limited to 250,000 ideally. Also keep in mind that with the transfer of the property into your name and associated bond registration, if any, transactional cost will be payable to the conveyancers attending to those aspects. Another thing to consider is what we call location, location, location. It's often and a repeated saying in the real estate industry, indicating the knowledge that the location of a property has a significant impact on its market value determination. As investor, you should therefore look at the property's proximity to good schools, retail areas, and green spaces. It will be informative also to speak with a few estate agents in the area in order to form a picture of the neighborhood and its residents. Another item to consider is choose the right house. Do not choose a property which requires substantial renovations. Homes with serious structural faults such as unstable foundations or weathered roof beams are expensive to repair. Even if the amount spent is warranted from an ARV point of view, the time to perform renovations will be longer, and to recoup borrowed money and make a profit is reduced by the interest payments. Therefore, it is advisable to rather choose a property with a sound structure to keep renovation costs down. For this purpose, spend the time and money to obtain professional builder or architect's input. The difference between a viable, successful investment and one that simply costs more money and time than its resale worth is proper research and knowing which home to choose. Changing market conditions play a huge role. The investment buyer, now the seller, may need to hang on to the property for a long time before selling it on for a profit. In today's market, people can no longer flip a property as quickly as they were able to in boom times. Our third item that we will be looking at is Are sectional title and HOA investments a better option than buying freehold homes? Well, in a 5 February 2024 Buy Community article, it was recorded that sectional title residential house prices in the last quarter of 2023 have risen faster than freehold homes. And this was for the first time in 2 decades. Percentage-wise, the growth in that period for sectional title property showed a 1.8% increase compared to the 1.5% in freehold homes. The gap widened even further towards the end of December last year, when the prices of sectional titles increased by 1.9% versus just 1.1% for freehold homes. That is some good food for thought when you want to consider going for sectional titles versus freehold homes. Statistics from leading agencies and Lightstone reports suggest further that the demand for sectional title is continuously increasing. Consider the fact that in 2013, just 44.6% of all residential property sales across the 5 major metro housing markets were sectional title homes. By 2023, a decade later, the market share of sectional title property sales had risen to 53.1%, more than half of all homes sold. That's an increase of nearly 10%. Lightstone data reveals that while the median price of sectional title properties in most major metro markets averaged less than 1 million last year, there are outliers. Cape Town, for example, recorded a median sales price of 1.7 million and continued to strengthen to 1.75 million in early 2024. Amongst the 5 major metros in South Africa, the largest percentage of sectional homes sold last year was, funny enough, in Tshwane. Cape Town registered a market increase in the percentage of sectional title sales last year, but in Johannesburg, the least amount of sectional title homes are being sold currently. There are many factors that contribute to the increasing demand for sectional title properties, including affordability, amenities, security, shared maintenance, lock-up and go, and hassle-free flexibility, and the like. Many of these attributes are also present in properties in homeowners association developments. Prices are often somewhat higher because the properties are bigger. Although the legal substructure of sectional titles and homeowner association developments are worlds apart, these superficial benefits are similar from a buyer and investor's point of view. Due to the apparent popularity of sectional title investments, it is considered advisable to investigate the option of doing a fixer-upper in respect of a sectional title unit, and that you don't restrict your research just to freehold properties. Then, the 4th item that I want to discuss with you this morning is the buy-to-let option. A well-managed buy-to-let property is for many investors an attractive and rewarding investment opportunity. And now recently, with the likes of Booking.com and those online platforms of letting property out on a short-term basis, has also made it attractive to buy property so that you can let them out. As mentioned throughout this presentation, you need to do your research though. Tax implications play a big role, and a tax advisor's opinion should accompany your decision-making. It is also necessary to make up your mind whether you see the buy-to-let option as a long-term investment or merely short-term. This particularly because of the fluctuation in the rental market after the COVID epidemic. According to PayProp's 2024 report on the rental industry, rentals grew a sustained 4.6% year-on-year in October, November, and December 2023, for an unchanged 4th quarterly growth rate from the previous quarter. While it's too early to say for sure, that looks like it has reached the plateau. Growth in each month fell below the post-COVID peak of 4.9% recorded in September, which was the fastest since 2017. While it now appears that rental growth will not return to the 6 to 8% seen in the mid-2010s, a period of stability could be an opportunity for the residential rental sector, even if growth flattens out. Seen this way, it's clear why in PayProp's State of the Rental Industry Survey 2023, 84.3% of respondents said that they were optimistic about the future of the rental industry. Depending on interest rates and inflation, stability in this market makes rent to buy a very attractive option. According to Statista, figures issued in December 2023 support a stable forecast. They state, the growth of residential rents in South Africa has accelerated in 2022, and this trend continued in the first half of 2023. In the second quarter of 2023, residential rents rose by 4.4%, which was almost 2 percentage points higher than the same quarter in 2022. This trend was observed across all provinces in South Africa. But does it make some financial sense? Well, investors in this market should take caution not to overpay for a prospective buy-to-let property if you will not get the rental amount on which you base your budgeting. Obtaining a realistic estimate of market-related rentals in your chosen area is crucial. Speak to rental agents, search property-related websites, and review the classified section of the local newspaper, amongst other things. Also, budgeting. If you are planning to finance it with a loan from a bank, the monthly installments must form an important component of your budget. Will the rental income cover the bond repayments? Is a good question to ask. Potential return. You will often hear buy-to-let investors talk about the rental yield on their properties or property portfolios. The yield refers to the annual rent that the investor earns from the property, divided by its value expressed as a percentage. For example, a house worth 1 million, on which the annual rent is 120,000, 10,000 Rand a month, would have a yield of 12%. Yield is accordingly a gross yield calculated before costs. Therefore, out of that yield, you will have to make bond repayments, cover building insurance premiums, find money for maintenance, and possibly pay a letting agent's fees. Additional costs that may be found in this sort of project could lead to a situation where your yield will not be enough to cover all the costs that are applicable and associated with a rent or with a buy-to-rent option. So it is, as I therefore mentioned, of paramount importance that you do your budgeting in the beginning of the phase. Okay, I skipped a few slides there. Just want to go to buy-to-let. Yes, there we are. Okay. Residential leases have a particular set of challenges is another thing to consider when you go with this option. Tenant vacancies is the first one that we need to have a look at. It is important to factor in the possibility of tenant vacancy to ensure that you are financially geared for this eventuality. If a tenant dies, falls ill, or is retrenched, you may suddenly end up with an unlet property and no rental income whatsoever, not to speak about the yield that we just mentioned. There are a number of insurance companies that offer rental insurance to landlords, but this type of cover comes at a price. Often these products only cover 3 months rental, capped legal costs, and malicious damage to the property. Disruptive tenants. While your tenants may be exemplary ratepayers, there's always the possibility that there are difficult tenants which could make your life a nightmare. Overly demanding or litigious tenants cause enormous emotional and financial stress, which may result in appointing an attorney to address the dispute. In addition, tenants refusing to vacate at the end of a lease cost you dearly. You are unable to put a new tenant in a property until such time as you have applied for and obtained an eviction order. This can be anything between 6 to 8 months, and it's going to cost a pretty penny. Nonetheless, with good homework and budgeting, this form of investment has proven to be popular and very successful. Mortgage bond appetite. We said in the beginning of this presentation that this will definitely play a role for people who don't have the cash lying around to finance the property investment from their own cash. You will then have to have a look and see whether the banks out there still have an appetite to basically fund your investment venture that you want to go on. And currently, the banks definitely do have that appetite still. If we look at this graph over here, it will show the various banks include, and it's called the 4 major banks, and then now recently Investec has also come onto the scene, and they've actually grown quite a bit. But in that graph, you will see that that's the amount of loans and the bank's growth over the last 10 years or so have shown that the banks are willing and able to provide the loans out there. And if your credit score is in good standing, chances are very good that you will qualify for that loan. And lastly, I just wanted to mention that the banks out there also have a lot of offerings at this point in time where they also pay a portion of the buyer's costs that are basically included in the mortgage loan that is being granted to the buyers. And some banks like Standard Bank are quite aggressive with this sort of marketing approach out there. They are hungry to get business, and they've ramped up these campaigns to basically invite people with good credit scores to apply for a home loan. As I said, Standard Bank is quite aggressive with that, and normally the costs that are added to the bond only is applicable to first-time home buyers. But with Standard Bank now, they've even extended that offering by allowing one first-time home buyer to include a co-applicant who is not a first-time home buyer. So to answer that question that might arise, yes, the banks are there, willing and able, and they are a good source of funds out there if you decide to start investing in immovable property in South Africa. So yeah, I mean, in short, as to end off, many people wonder whether it's good to invest in the property market. My answer to that is definitely yes. If you look at the size of South Africa's property market, it's definitely one of the very active economic sectors out there. And it is also sort of stable. If you look at businesses out there like coffee shops and other startups, those people are really struggling at this point in time. But for some reason, the property market stays resilient, and there's always good activity out there, and therefore a good opportunity to get into investment if you have the appetite for it. Thank you to all for your time this morning and that you've joined. As Leonie said, if there's some questions, we will have a look at them. And then my email address will also be shared with the people who want to get some more information on what was discussed this morning, or maybe not. Thank you to all.
Thank you. Thanks so much, Armand. I think we do have a few minutes left, and I do have a few questions that we can deal with. So if it's okay with you, we can tackle a few of them while we still have a bit of time.
Sure.
The first one is from John Henry. Well, John Henry has sent us quite a few. But the first one is at the at the start of today's session, he mentioned that both of us, both you and I, mentioned that at this particular point, it's quite a decision to invest in property, and he's asking why, in our opinion, is it why at this particular point in time, and why so, and why is it different than say a year ago or in a year's time?
So yeah, I mean, my answer to that is it lies in the size of the property market, as I've been mentioning quite a few times this morning. It is a stable investment opportunity out there. It is not as volatile as retail, for instance, at this stage. And you know, last year, the property market was really struggling. I think that was basically based on the after effects of the COVID period. Also, many people bought property shortly after, or when we just came out of hard lockdown, because the interest rates were low. And in 2023, when the rates started going up, it was a bit of a challenge for many property owners out there to hold on to their properties. But the sentiment is quite good at this stage, and many people and economists believe that 2024 might see a turnaround in the property sector, and with the prospects of the interest rates possibly going down from this year onwards, it is definitely an affordable form of investment.
Thank you. Yeah, and I think also just to add to that, and seeing it from an investment point of view, is that with the like rise of Bitcoin and things like that, it's always a question of whether you should still invest in property or not. But as Armand indicated, I think that it's still a good investment, and especially within South Africa. So that was the one question. Then Arlene Henry has a question on how many days or months from occupation date to the purchasers have to do their snag list for developers to rectify any issues.
Okay, so there you will have to have a look at what the offer to purchase stipulates. There's many developers have their own form of timelines. And when you sign that offer to purchase, it's vital that you familiarize yourself with the timelines in there, because in the agreement itself, it will stipulate that basically, or for an example, from about 10-15 days from the date that you occupy the property, you have time to submit your snag list. So there's not a specific law out there that puts a time limit on it. It is what is stated in the offer to purchase. And as I said, you have to make sure that you understand what's in there and what is expected of you when you take occupation of the property.
Great, thanks. Then the next question from John Henry is, do you have a formula of sorts that accounts for shortfall between rental fee and monthly bond repayment, levies and rates? Obviously, no shortfall is ideal, except when it comes to writing off for tax, but do you have a recommended percentage bracket that one should consider?
Sure, that's a tough one. I don't think that there is really a formula. The only formula that formula that I can refer to is getting all those stats and figures from your estate agent before you buy the property, and you basically sit down and you do a budget. If you struggle with something like that, then it's also good that you maybe seek the advice of a tax consultant or even a normal accountant that can calculate those things for you, so that you don't find yourself in a situation where the shortfall is too much, and you can't really pay that, and basically have to offload the property at a reduced price later on. So yeah, as I said, there's not really a formula out there. Expert advice is definitely something that is required in those calculations from an accountant's perspective.
Okay, thank you. Then Kagiso asked, can I pay home loan daily to offset the interest that accumulates daily? By setting up daily automatic payments, the accumulated that accumulate to the monthly bond repayment. So I think it's more about reducing your interest on your monthly payment for your bond.
Yeah, you can do that. You will just have to have a look at what your loan agreement with the bank stipulates in terms of paying a bond off sooner. But most banks do allow you to make regular and more payments as what was agreed to in the loan agreement so that you can reduce your interest payments. Yeah, short answer to that is definitely you will be able to reduce your interest obligation to the bank by making more regular payments.
Okay, then can I use my access bond as an emergency fund? And can the bank revoke my access bond at their discretion?
Yeah, you can use it as an emergency fund if you need extra cash. And the products out there by the banks, some of those products differ quite vastly. There's in many instances a list of requirements by the bank in order for you to have access to those funds. So it is always advisable that you make sure of those requirements and that you don't sit in a situation where you're not able to access the funds for not following any of those rules and obligations. And then lastly, the second part of that question, yes, the banks may definitely revoke that access facility. I think the first one that springs to mind is if you skip a bond repayment, then that facility will definitely be closed by the bank, and you will have to basically arrange with the bank to get up to speed with your bond repayments in order for them to reopen that access facility. But that the reasons for the bank being able to close the access facility, you will definitely find that in the loan agreement that you will sign with the bank before the bond is registered. So it's good that you read that loan agreement and understand the obligations on you as the person who has been granted the loan.
Thank you. Then Ababawa has a question regarding whether trust is a good idea for minors and within a family structure. And if you don't mind, I'm going to answer that. Is that Babawa, there was quite a good presentation that we did last year with our trust experts, Jacques and Kelly, regarding trusts and setting them up, and you can find that on our YouTube channel. Otherwise, you can also contact them directly on trusts@stbb.co.za so that you can perhaps have a look at exactly what trust structure you need and whether it is specifically good for you, what your needs are. And then the last question, I think, before we dial off is please advise if one can register a property on a child's name, even though the property may still be owing.
Even though the property
Might still be owing. So I think it's more a bond or something that's in place, and you actually want to transfer the property into a child's or a minor's name.
Yeah, so if there's still money owed on the bond, you will have to pay the bond up, and the bond will have to be cancelled in the deeds office before that transfer could happen to the minor. There's no ways that that the bank or that the bank will allow the minor to step into the shoes of the person to which that bond was granted, because a minor just doesn't have the legal capacity and also won't have the finances to pay for that. So you can transfer into a minor's name. The minor will have to be assisted by the legal guardian, but all obligations to the bank need to be settled before that transfer can happen.
Thank you. I think the last question that I'm going to take is the one from Ramsey. If your rental income does not cover your bond repayment and levies, is property still a good investment? Example, 2.5 million apartment will cost me roughly 4.5 million after 20 years, but it will never be worth 4.5 million.
Yeah, it will definitely. When you look at buying a property, it's not always advisable to look at the rands and cents exactly like that, as what you described it now, because whilst you're getting an income from the property, and you use that income that you basically generate through renting out the property, and you pay the monthly bond installments, you're probably going to sell the property at a profit later on. And that's where the investment opportunity lies. Yes, it probably won't be worth 4.5 million, but somebody else paid your bond off while it was you had to make those repayments on a monthly basis. So yes, it's definitely still a good option, even though you might sit in a situation where the rental income does not cover all the expenses. If you have to pay in a little bit, but you're selling the property at a profit later on, it's a good investment.
Yes, and I think you also have got the added benefit when you've got a property that you can gear against it to make a further investments, which is something you don't have with some other type of investments like a type of funds or things like that. So my view, you've got added benefits, even though it's not like you said, amount like a rand and cent value like for like that you want to compare with each other.
True.
So thank you so much, everyone. John Henry also noted your question regarding the Cape Town and surrounding areas. I'm going to get someone from our departments to get in touch with you because there are quite a few investment opportunities in and around Cape Town at this point that are up and coming, and that I think you can get a good bargain for your buck. So we will get in touch with you regarding that. So thank you so much, everyone, for joining us for today's session. And thank you, Armand, for imparting all your knowledge regarding investment and investing in property and what would be the best way to go forward. As I mentioned, we will be sharing with you our recording afterwards, as well as just a handout just to summarize today's session. Again, you're more than welcome to get in contact with either Armand or myself and our team to answer your questions, or if you've got any other queries or concerns that you would like us to help you with. So once again, thank you so much. And lastly, also from our side, please look out for our webinar next month, which would be dealing with AI and specifically in the lawyer environment and also property environment, and how it can benefit you, and also things that you need to look out for. So that's going to be quite a nice webinar to attend as well. The link is in the chat for you to register. So thank you so much, everyone, for joining today, and hope you all have a good Thursday, Friday, and weekend.
Thank you. Bye.